This presentation was originally broadcast as a webinar on February 14th, 2007. My name is Milind S. Pundit, and I'm Director of Product Management at Carillion Corporation. Carillion is the market leader of online banking, bill payment, and fraud prevention applications. We serve the financial services industry. 28 of the top 100 U.S. banks and 20 of the top 100 U.S. credit unions are Carillion customers. Overall, Carillion serves over 25% of the online banking population in the U.S. I manage a number of Carillion's offerings related to online banking and online banking security. To quote Stephen R. Covey, I like to begin with the end in mind. For this webinar, I'd like to begin with the ideal product manager in mind. I think we can all agree that the ideal product manager is the CEO of her product. She treats the product under her management like a business, and if she manages multiple products, then she treats them like a portfolio of businesses. Such a person has a number of other qualities. First, the ideal product manager is well informed about her product, its features, about her customers, partners, and competitors. A critical component of being informed is having an up-to-date view of the expenses and income associated with the product. The ideal product manager makes rational decisions on the basis of this information. In particular, she is concerned with the return on her company's investment in her product. This return can be measured either by internal rate of return or net present value. She is also actively mitigating the risks to her product business. Based on this information, she'll choose rational investments. She might invest in additional personnel, tools, or marketing campaigns. She might even advise the acquisition of other companies. She may also choose to divest by sunsetting a product or moving personnel off the product or advising the sell-off of a business. The ideal product manager manages multiple initiatives, whether that means multiple products or multiple features of a single product. And he rationally introduces new initiatives to add to the mix. This means he has to compare proposed initiatives to initiatives already underway. What prevents us mere mortal product managers from achieving these ideals? One of the basic challenges is uncertainty. Steve McConnell introduced the concept of the cone of uncertainty shown in this chart. All this shows is that at the beginning of a product development project, the estimates are wildly off. They could be estimates of effort, cost, or required features. As time goes by, as more information is gathered, and as the product development actually proceeds, the estimate becomes closer and closer to the actual. And of course, at the end of the project, it reaches the actual. This cone of uncertainty means that a brand new proposal is highly uncertain, while initiatives already underway have more certainty. This makes them hard to compare. So we need a way to model this uncertainty. Risk is another challenge related to uncertainty. Rudy Klein of Lucent did a prior webinar on managing the risks of product portfolios. As he described, the risk and return of each investment in a portfolio must be understood. Only then can you maximize the return and minimize the risk of the portfolio as a whole. So we need a way to model risk. Another challenge is hedging or mitigating risk. In equity investment, when you purchase a stock or bond, the risk is that the expected capital gain or yield will not be realized. We hedge this risk by purchasing derivative instruments, call options and put options. We make a small investment upfront that gives us contingencies in the future. A product manager is concerned with investment in a business. The risk here is typically that the expected revenue will not be realized. We hedge this risk by exercising what are called real options. Real options are nothing but choices or plans of action that you take to promote a desirable outcome in your project. We all have an intuitive sense for real options, but the term was coined by Stuart Myers of the MIT Sloan School of Management, who has researched them in great detail and compared them with derivative instruments. The problem with real options is tracking them, keeping in mind which are available, how much they cost, and how they might affect the outcome of your project. We need some way to do that. There is a problem with complexity in general. As I mentioned earlier, most product managers must keep multiple initiatives going simultaneously. I like this image of the product manager as a juggler. Those of you who have tried it know that juggling 3 balls or 3 bowling pins or 3 rings is hard enough. But it's much harder to juggle 1 ball, 1 bowling pin, and 1 ring because you have to keep adjusting your grip and the strength and direction of your throw. The same is true of product management. It's hard enough to manage multiple initiatives, but they're typically very different. You may have one mature product that is a cash cow, another product requiring a lot of market research and testing, and another that needs some channel partners. And when yet another new opportunity comes along, how do you compare the proposed investment with ongoing initiatives? How do you know if the bird in the hand is really worth two in the bush? You need some way to treat each of them in a comparable fashion. Any number of tools have been proposed to help you manage your products. The fact is, if your management tool is overly complex, then it is more likely to get out of date. If it is out of date, then you will distrust it. If you distrust it, then you will use it less, meaning it will be more out of date. You'll waste time on the tool because at the end of this vicious cycle, you'll stop using it. On the other hand, if your management tool is simple, you're more likely to keep it up to date. You'll trust what it tells you and use it more, and it'll be far more valuable to you. I'm not the first to emphasize simplicity. For example, Preston Smith is the author of Developing Products in Half the Time, and he recommends using a simple financial model to expose the opportunity cost of any delays in product development. The solution I propose is not a silver bullet to solve all product management problems, but I have found it to be a useful tool to overcome these challenges and at least approach the ideal. Here's how it works. First, predict cash flows for your initiative. This allows you to determine the return on your company's investment in the product. More importantly, it lets you compare multiple initiatives on the rational basis of return on investment. Second, represent uncertainty and risk through PERT estimation. This means best case, likely, and worst case predictions of cash flows. By representing uncertainty and risk for multiple initiatives, you'll be able to maximize your ROI and minimize your risk across the whole portfolio. Third, incorporate options into your model. This will let you mitigate risks to maximize the return on your product investments. Fourth, keep your model up to date. If you let it get out of date, then it will become useless and no one will trust it, including you. As new information becomes available, adjust your model's predictions. As decisions get made, ensure that they're reflected in your model. The big challenge is to keep your model as simple as possible. When I want to simplify almost any subject, I challenge myself to encapsulate it in one page. As an example of this solution, I want to describe the purchase, improvement, and sale of a house. Let's say you're going to buy a house. Here's how you would model it. First, before you even look at any houses, you would try to predict what your cash flows would be. You might decide to make a 20% down payment on a $300,000 house and borrow the remainder at 5.75%. During the year, you would make your down payments and your monthly mortgage payments. Each of those would pay down the loan somewhat. At the end of the year, the house will have appreciated by about 5%. Your internal rate of return would be 3.6%. Now, right off the bat, if you can successfully model all your initiatives to this extent, then you're in a good position to make rational, informed decisions and compare initiatives reasonably well on the basis of internal rate of return or net present value. But a critic, a devil's advocate, is going to say that the assumptions are too aggressive and they're leading to a rosy prediction. If you're asking for a large investment or competing against other product managers for the money, then people are going to question your assumptions. They'll say it looks okay, but what if things don't work out that way? So you would introduce uncertainty into your model. You would model best and worst case scenarios in the house price based on a market assessment and your bargaining power. You would model best and worst case scenarios in the interest rate based on the range of interest rates offered by banks and credit unions. And you would model best and worst case scenarios in the house value at the end of the year based on different appreciation or depreciation scenarios. You would end up with a best case IRR, which is your upside if everything goes well. And you would have a worst case IRR, which is your downside if Murphy's Law holds true for your project. If you can model all your initiatives to this extent, then you can compare initiatives while accounting for risk. If you find yourself engaged in a highly risky project with minimal returns, you might unwind that project in favor of one with lower risk or better returns. But what if your critic tries to nix your project by pointing out that your downside is larger than your upside? What could be done about it? Is there any way for you to influence the value of the house after 1 year? Of course, you would consider various upgrade options, various investments that would improve the value of the house. For each option, you would model the best case, middle case, and worst case cost. Here, I've shown the costs of a fresh paint job, roof replacement, flooring replacement, landscaping, appliances upgrades, air conditioning, and fence replacements. The cost of the options would go into your cash flow prediction, and you would raise your expectations of the value of the house at the end of the year. Based on the improvement in the middle case scenario, you might decide to go ahead with the purchase. Now, when you actually make the purchase, a number of cash flow items that were uncertain items become fixed. So you would make the best, middle, worst case scenarios the same for those items. For other items, you might learn some relevant information, so you would adjust your scenarios. This is how the cone of uncertainty would get reflected in your model. In this case, you paid slightly more than expected for the house. So you make the price the same in the middle, best, and worst case scenarios. but you got the best interest rate, so you equalize that line. Perhaps a comparable house in the same neighborhood sold at a substantial premium, so you would increase your best case scenario for the value of the house. Perhaps the inspection revealed that the roof is in good condition. So for now, you changed the best case scenario for roof replacement to 0. At this point, the only way to influence the outcome is to actively manage your options. So you would be highly motivated to minimize or delay incurring the cost of those options. As the months went by, you would shop around for the least cost on your upgrades and exercise some of your options by purchasing upgrades. Some options you might choose not to exercise. You might prefer to delay the upgrade for a future date. You might find that the roof should last another 5 years, so you certainly need not invest in replacing it this year. You might find a great carpet cleaner who cleans all the carpets instead of your having to replace them. You might find that the fence should last another couple of years, so you'll spend nothing on it this year. After saving money on those options, you might decide to splurge on landscaping, paying closer to your worst case scenario. For the remaining options, you may end up paying the middle case. At this point, you would feel comfortable that you had done everything possible to maximize the return on your investment. And indeed, though some downside remains, the upside is still good, and the middle case scenario is the best it has been. As you go along keeping your model up to date, you may find that the best and middle case ROI become negative or sink to an intolerable level. In that case, you would know that it is time to divest yourself of this initiative, not throw good money after bad. If you have multiple initiatives, it would be easy enough to manage each of them on a separate page and keep a summary page of consolidated cash flows for your portfolio. The best, middle, and worst case cash flow scenarios for each initiative would roll up into the consolidated cash flows. If you were considering a new initiative, you would model it out in this same way. You might choose to reject the new initiative because it has higher risk for the same ROI, or because it has lower ROI for the same risk. In any case, by using this model, you would be in a position to make an informed, rational investment or divestment decision about multiple products. Because this is a simple methodology dealing with cash flows, it becomes possible for a person to manage multiple initiatives in a uniform fashion. If the models are kept up to date, then even if those initiatives are in different stages, it will be possible to accurately compare the ROI and risk of each initiative. Finally, no product manager is an island. By representing your product in a simple one-page format, you'll be able to communicate effectively with others in your organization, including executives, salespeople, engineers, financial analysts, and marketers. An enhanced ability to influence your organization will be one of the best benefits of communicating ROI, risk, and real options in one page. Now let's cover some of the questions that came up during the webinar. First question, you represented financial risk, but what about time risk? Answer, to represent time risk in the different scenarios, simply change the date on various cash flows. Second question, how do you model intangible factors like marketing tactics by competitors? Answer, ask yourself how they will affect cash flows. Will a competitive move really eliminate all projected revenue? Also, accept that the numbers don't tell you everything. A gut feeling may make you ignore the numbers. A political situation may make you ignore the numbers. Then it becomes a conscious choice. What you don't want to do is to rely on your gut or blame a political circumstance because you didn't know what the rational decision was. Frequently, the executive team is looking to product management to provide them with the rational decision. In the absence of this information, they're forced to rely on their guts or their political pull to make a decision. Third question. The example is contrived. What are challenges implementing this in a real company? Answer. The personal challenge is relatively easy, but it is still non-trivial to gather the information and keep it up to date for a large number of initiatives. The organizational challenge is much harder. Various stakeholders may reject the definition of the ideal product manager. They may feel you are stepping on their toes by tracking this. They may not have built trust in your model and may resist making decisions on the basis of it. That is why the process needs to be kept simple and trustworthy.